On the evening of Friday, September 12, 2008, Henry Paulson, the United States Secretary of the Treasury, stood in a wood-paneled conference room in the basement of the Federal Reserve Bank of New York and delivered a message to the assembled chief executives of Goldman Sachs, Morgan Stanley, J.P. Morgan Chase, Merrill Lynch, Citigroup, and half a dozen other firms that between them held the American economy's balance sheet. Paulson had served as the chief executive of Goldman Sachs. He understood every man in the room. He understood what he was about to say would terrify them. He said it anyway. There will be no government bailout for Lehman Brothers, he told them. Not a penny. Whatever happens this weekend, the private sector will solve it. Then he sat down. At that moment, Lehman Brothers had $639 billion in assets and 158 years of history. It had survived the Civil War. It had survived 2 world wars. It had survived the crash of 1929, the Great Depression, the collapse of the bond market in 1994, the Russian debt crisis in 1998, and the destruction of its own headquarters on September 11, 2001. It had outlasted every financial catastrophe in American history. It had 72 hours left. You would not know that from looking at Lehman Brothers 2 years earlier. Lehman in 2006 was not a firm in trouble. Lehman in 2006 was the envy of Wall Street. Its assets had more than tripled in 7 years, from under $200 billion to $691 billion by 2007. Its stock reached an all-time high of $86.18 per share in February 2007. It employed more than 28,000 people across offices in 43 countries. It was, by almost every measure, the most profitable it had ever been in its entire history. But more than the numbers, Lehman was an institution. It had financed the railroads that knit America together. It had underwritten Sears, Macy's, Woolworths, and Studebaker. It had helped build the American film industry, backing Paramount Pictures and 20th Century Fox in their earliest years. It had served as an official dealer for the United States Treasury. Its name was synonymous with Wall Street's deepest roots and its most enduring ambitions. When a Lehman partner walked into a room, rooms noticed. To understand how a firm with that history and that scale could file for bankruptcy before sunrise on a Monday morning, you have to understand what Lehman actually was by 2006 and what it had chosen to become. To find out, we have to go back to the beginning, Montgomery, Alabama, 1844. A 23-year-old Bavarian immigrant named Hayum Lehman stepped off a ship in New York Harbor in September of that year, changed his name to Henry, and made his way south to Mobile, where he spent a year as a traveling peddler loading a wagon with household and farm goods and moving through the Alabama River counties. He understood something about the region within months of his arrival. Cotton was not merely the crop of the American South. Cotton was the economy. The banks, the merchants, the roads, the credit, the labor system that held it all together. Cotton was the physical currency of a civilization, and the men who controlled its flow controlled everything. Henry settled in Montgomery in late 1845, rented a small wooden structure on Commerce Street, and opened a dry goods store. He sold sheets, shirts, yarn, and coarse fabrics. And because the farmers he served had cotton rather than cash, he took cotton as payment. Within a few years, the cotton itself became the more valuable business. When his brother Emanuel arrived in 1847, the firm became H. Lehman and Bro. When the youngest brother, Mayer, arrived in 1850, it became Lehman Brothers, and the name would survive, in one form or another, for the next 158 years. Henry died of yellow fever in New Orleans in 1855 at 33. Emanuel and Mayer continued. When the Civil War began, the Union blockade cut off the cotton trade. Mayor Lehman, who had aligned himself with the Confederacy, appointed himself a commissioner to visit Alabama prisoners of war held in federal prisons. The firm survived the war by routing cotton through England, moving it outside the blockade to reach textile mills in the North. After the war, Lehman Brothers was designated the fiscal agent of the state of Alabama, selling state bonds to service its Reconstruction debts. The firm moved its headquarters north to New York, helped found the New York Cotton Exchange in 1870, and then, as the cotton trade matured, began the slow evolution into something larger. It joined the New York Stock Exchange in 1887. It underwrote the emerging retail empires of the Gilded Age. It helped finance the railroads and the petroleum industry. Under Robert Lehman, who led the firm from 1925 until his death in 1969, It funded the television industry, the airline industry, and the early computer sector. Robert Lehman had been at the helm since 1925, and the Depression tested everything his family had built. Where other Wall Street firms retrenched, Lehman turned to venture capital, backing companies that other investors considered too speculative for a collapsing market. It underwrote the initial public offering of Dumont Laboratories, the first television manufacturer in America, and backed the Radio Corporation of America. It financed Halliburton and Kerr-McGee in the oil fields of Oklahoma. It helped fund Pan American Airways and what would eventually become American Airlines. The pattern was always the same: identify the next economy, finance it before the market understood what it was, and collect the returns over a decade rather than a quarter. The Depression killed firms that were leveraged to yesterday's assets. Lehman survived because Robert Lehman kept betting on what came next. For most of its history, Lehman's genius was recognizing what the next American economy would run on and financing it before anyone else did. Cotton, then railroads, then retail, then entertainment, then technology. The firm had an instinct for the country's center of gravity and a talent for being there first. Robert Lehman died in 1969, and for the first time since 1844, no member of the family ran the firm. What followed was a long, turbulent restructuring. A merger with Kuhn, Loeb in 1977, an acquisition by American Express in 1984. Years of internal conflict between the firm's bankers and traders that became so toxic, it earned its own name on Wall Street. Lehman Brothers, they said, had only two departments: the enemies of its enemies and its enemies. American Express eventually grew tired of the dysfunction and spun the firm off in an initial public offering in 1994. Richard Thuld had been at Lehman since 1969. He had risen through the trading desk, surviving every purge and restructuring, emerging each time with more authority and fewer rivals. He became chief executive when the firm was spun off, and for the next 14 years he ran it with the focused, combative certainty of a man who believed Lehman's survival had always been a function of his own will. He was not entirely wrong. Under Thuld, the firm rebuilt itself from a newly independent entity of modest scale into a genuine Wall Street power. His traders called him the Gorilla. He liked the name, and this is where the trap was set. In the years after the 1999 repeal of the Glass-Steagall Act, which had separated commercial banking from investment banking since the Depression, the major Wall Street firms found themselves operating in a newly deregulated landscape with access to enormous amounts of borrowed money and new instruments to package and sell risk. Lehman moved aggressively into two areas that would define the next decade. The first was proprietary trading, using the firm's own capital to bet on markets. The second was the mortgage business, originating home loans, packaging them into securities, and selling them to investors worldwide. This is the part that most people miss. The mortgage securities business was not, by itself, the trap. The trap was leverage. To finance its growing positions, Lehman borrowed enormous sums of money, short-term debt that had to be rolled over constantly, using its own assets as collateral. By 2007, the firm was leveraged at roughly 40 times its shareholders' equity. This means that for every dollar Lehman actually owned, it had borrowed 40 more. A 2.5% decline in the value of its assets would erase the firm's entire capital base. The model worked spectacularly when asset prices rose. It was a loaded weapon pointed at the firm when they fell. And there was a specific problem embedded in the portfolio that Thuld's own risk officers had identified and could not fix. Lehman had accumulated a massive concentration in commercial real estate. When the firm packaged residential mortgages into securities, it sold most of the resulting bonds to outside investors. But the commercial real estate positions it largely kept, holding them on its own balance sheet. By 2008, Lehman held roughly $60 billion in commercial real estate assets, a portfolio that was illiquid, concentrated, and losing value every week. Madeline Antonchik, the firm's chief risk officer from 2004 to 2007, had tried repeatedly to warn Thuld about the growing exposure. She was removed from the role in 2007. The warnings did not stop the accumulation. They were the warnings that were stopped. The company had seen what was coming. The decision that followed was not ignorance. It was denial, dressed in the language of confidence. By early 2008, the crisis in the American housing market was no longer a matter of debate. But here's what most people miss. The warning that should have restructured Lehman's relationship to leverage had arrived a full decade earlier, and Fold had been in the room for it. In 1998, a hedge fund called Long-Term Capital Management, run by Nobel Prize-winning economists and staffed by some of the most sophisticated quantitative traders on Wall Street, nearly destroyed the global financial system. LTCM had accumulated positions worth roughly $1 trillion, financed through leverage of roughly 25-1. When the Russian debt default triggered a cascade of losses, LTCM's model broke down simultaneously across every market it traded. The Federal Reserve organized a private sector rescue, and the 14 major Wall Street banks, including Lehman Brothers, contributed to a $3.6 billion bailout to wind down the fund in an orderly way. Every senior banker in America spent the autumn of 1998 studying the same lesson. A highly leveraged institution using sophisticated models to manage risk does not fail gradually. It fails all at once, faster than any model predicts, at exactly the moment when the collateral it depends on loses its value. The lesson was not that leverage was dangerous. The lesson was that leverage beyond a certain ratio did not merely amplify risk. It transferred control of the institution from its management to its creditors. Lehman Brothers was leveraged at 40 times its equity by 2007. LTCM had nearly collapsed at 25. The lesson had been studied, documented, and taught in business schools for 9 years by the time Fold's balance sheet exceeded it by 60%. The rescue sent a message the entire industry heard: the government would not let a major financial institution fail. The systemic consequences were too severe. Richard Fould heard that message and made a calculation that would prove to be catastrophic. He believed Lehman would be rescued too. It is the spring of 2008. Fold is at the Lehman annual shareholder meeting in April, and the questions are not gentle. The stock has fallen sharply since the start of the year. There is open concern about the firm's real estate exposure. Fold stands at the podium and delivers a phrase that will follow him for the rest of his life. The worst, he tells shareholders, is behind us. He is not dissembling for show. He appears to believe it. And this is the forensic core of what happened to Lehman Brothers. The CEO of a 158-year-old institution facing a documented and specific liquidity crisis looked at what Bear Stearns had received in March and concluded that Lehman would receive the same. The entire strategy of the spring and summer of 2008 rested on the assumption that the government would step in. It was a strategy built on a guarantee that did not exist and would not come. While Fold waited for rescue, the firm was concealing the extent of its distress. Lehman had been using an accounting maneuver called Repo 105 since at least 2001. In a standard repurchase agreement, a firm sells assets for cash with an obligation to buy them back days later, and the assets remain on the balance sheet. In a Repo 105 transaction, because the assets sold were worth at least 5% more than the cash received, accounting rules permitted Lehman to classify the sale as a true sale rather than a financing, temporarily removing the assets from the books entirely. By doing this at the end of each quarter, Lehman could make its leverage ratios appear significantly lower than they actually were. In the first quarter of 2008, Lehman used Repo 105 to remove approximately $49 billion from its balance sheet before publishing its financial statements. Without the maneuver, its net leverage ratio would have been reported at 17.3. With it, Lehman reported 15.4. These were not minor cosmetic adjustments. They were the difference between a firm that looked under strain and a firm that looked manageable. The legal opinion that permitted Repo 105 to be classified as a true sale under accounting rules had been obtained from a London law firm called Linklaters. Because no American law firm would provide the opinion that the transactions qualified as sales under United States law. Lehman ran the accounting device through its London subsidiary specifically to take advantage of the Linklaters opinion. One Lehman employee, in an internal email from April 2008, described Repo 1005 as another drug we're on. The bankruptcy examiner appointed after the collapse described it more precisely. Lehman had used the device to present a misleading picture of its financial health to investors at the exact moment it was reassuring them that the worst was over. But it gets worse. In June 2008, Paulson had told Fold directly in a private conversation that there would be no government bailout. He urged Fold to find a buyer while Lehman still had something to sell. Fold heard the warning, acknowledged it, and continued to wait. He approached the Korean Development Bank about a partial acquisition. He held talks with Bank of America. He opened conversations with private equity firms. Each set of negotiations dragged toward no conclusion. On September 10th, the Korean Development Bank formally withdrew from consideration. That same day, Lehman announced a loss of $3.9 billion for the third quarter, the largest in its history. The stock fell 45% in a single day. In September 2008, everything accelerated, and entirely in the wrong direction. On the morning of September 11th, J.P. Morgan Chase, which cleared the vast majority of Lehman's daily trades, suspended the more than $100 billion Lehman borrowed each day through the interbank lending market. Without that daily funding, Lehman could not operate. The firm was now measured in hours, not days. That night, Paulson called Bank of America's chief executive, Ken Lewis, and asked him personally to find a way to acquire Lehman. It is Friday evening, September 12, 2008. The New York Federal Reserve's stone headquarters, a building that looks more like a fortress than a bank, is lit against the Hudson River. Inside, the meeting Paulson has convened includes Timothy Geithner, the president of the New York Fed, Ben Bernanke, the Federal Reserve chairman, and the chief executives of Goldman Sachs, Morgan Stanley, Merrill Lynch, J.P. Morgan Chase, and Citigroup. 2 potential buyers remain for Lehman, Bank of America, and Barclays. Paulson stands and tells the assembled room what he had told Fold privately months earlier: not a penny. The only solution is a private one. The Wall Street chiefs are given 3 options to work on over the weekend: a consortium to absorb Lehman's bad assets, a structured acquisition, or a framework to contain the fallout from a bankruptcy. Nobody seriously considers the third option. Everyone assumes a deal will be found. Saturday passes in working groups, draft term sheets, and mounting arithmetic. The core problem is always the same: Lehman's commercial real estate portfolio. The $60 billion in positions accumulated over years of Fold's expansion is worth considerably less than its stated value. Any buyer would need that exposure guaranteed or absorbed. The private sector firms propose pooling $5 to $10 billion to create what they call a bad bank, a vehicle to hold the toxic assets outside the acquisition. Paulson rejects the number. He wants $25 to $30 billion. The bankers refuse. The gap does not close. On Saturday evening, Barclays agrees to buy Lehman's core North American operations, the investment bank, the trading desks, the prime brokerage. The deal excludes the toxic real estate portfolio. It is, for a few hours, the solution everyone in the building has been working toward. But Barclays faces an obstacle that neither Paulson nor Fold has solved. Under British financial law, a company making an acquisition of this size must obtain shareholder approval. A shareholder vote takes weeks. Lehman cannot survive weeks. Barclays needs either the U.S. government or the British government to guarantee Lehman's operations during the interim period. The U.S. Treasury has no legal authority to provide the guarantee. The British Financial Services Authority, whose chairman Alistair Darling has been kept only partially informed of the weekend's events, declines to waive the requirement. The regulator will not allow British shareholders to be exposed to an institution whose full liabilities are not yet known. On Sunday morning, it becomes apparent that the Barclays deal is not going to close. Fold, from the 31st floor of 745 7th Avenue, is making phone calls to anyone who will listen. Bank of America is no longer listening. It has spent Saturday in separate negotiations with Merrill Lynch and agreed by Sunday morning to acquire Merrill for $50 billion. The third option, the one no one wanted to consider, is the only one left. At 1:45 in the morning on Monday, September 15, 2008, Lehman Brothers Holdings, Inc. filed for Chapter 11 bankruptcy protection in the United States Bankruptcy Court for the Southern District of New York. The filing declared $639 billion in assets and $613 billion in debts. It was, at that moment, the largest bankruptcy filing in American history. The speed of the unraveling from that point forward measured the depth of the exposure. Within hours of the filing, the Dow Jones Industrial Average fell 500 points at the open, its worst single-day drop since the September 11th attacks. By the end of trading on September 15th, nearly $500 billion in market value had been erased in a single session. The next day, the Federal Reserve and Treasury organized an $85 billion emergency rescue of the insurance company, AIG, which had sold hundreds of billions of dollars in credit insurance on the same kinds of mortgage securities Lehman and others had accumulated. AIG had not been a bank. It had been the counterparty to the banks, the institution that had promised to pay everyone else if the mortgage securities fell below their stated value. AIG had written credit default swaps, a form of insurance on debt, totaling roughly $441 billion. When the mortgages did fall, AIG could not pay. And because every major financial institution on Wall Street had purchased some of AIG's protection, the failure of one insurance company threatened to unwind the books of all of them simultaneously. The rescue of AIG revealed the true architecture of the crisis. Lehman had not failed in isolation. It had been one node in an interconnected system where every institution's solvency depended on every other institution's willingness to continue lending, and where the failure of any single node could freeze the entire network. Within days, the panic spread beyond any individual institution. Money market funds, ordinarily considered the safest of vehicles, began to break the dollar, meaning their value fell below the $1 per share floor their investors considered guaranteed. The Reserve Primary Fund, one of the oldest money market funds in America, had held $785 million in Lehman commercial paper. When Lehman filed, those holdings became worthless, and the fund announced it had broken the dollar for the first time in its 14-year history. The news triggered a run on money market funds across the country. Ordinary Americans who had never heard of Lehman Brothers and did not know what a mortgage-backed security was discovered that the safest place they thought they kept their savings was no longer safe. The commercial paper market, through which corporations borrowed money to meet daily operating expenses, ceased. Companies that had nothing to do with housing or finance suddenly found they could not borrow the cash they needed to make payroll. Congress rejected an initial $700 billion rescue package on September 29, sending the Dow down 777 points in a single day. The bill passed on October 3. By the end of October, global markets had lost roughly $10 trillion in value. By the time the recession ended in June 2009, 8 million Americans had lost their jobs. 4 million homes had entered foreclosure. Household net worth in the United States had fallen by nearly $13 trillion from its peak. The recession that followed was the deepest since the 1930s. The firm that had survived the 1930s had, in its failure, produced conditions that echoed them. Barclays, which had been unable to save Lehman on the weekend, acquired its North American investment banking operations in a deal approved on September 19. On Tuesday the 16th, Robert Diamond, the chief executive of Barclays Capital, arrived at Lehman's headquarters at 745 7th Avenue and addressed the employees who remained. He announced that their firm had been bought. Then someone played God Save the Queen over the intercom. Nomura of Japan purchased the Asian and European operations a week later. The North American deal preserved roughly 10,000 jobs. The other 18,000 did not have jobs to return to. Richard Full testified before Congress in October 2008. Representative Henry Waxman asked him directly, "Your company is now bankrupt. Our economy is in crisis, but you get to keep $480 million. Is this fair?" Fooled, who disputed the figure and said he had taken approximately $300 million in total compensation over 8 years, said the pain of Lehman's failure would stay with him for the rest of his life. He has said very little in public since. Today, Lehman Brothers no longer exists in any operational form. Its bankruptcy estate spent more than a decade unwinding its positions in court, making partial recoveries for creditors from the wreckage of $609 billion in claims. At its peak in 2008, Lehman employed more than 28,000 people in offices on 6 continents. The number of people it employs today is 0. The name survives in the bankruptcy docket, in the Harvard Business School case studies that have used the collapse to teach risk management to every cohort of MBA students since 2008, and in the phrase that entered financial vocabulary after that September weekend, too big to fail, a principle the government had established by rescuing Bear Stearns in March 2008, and then shattered by refusing Lehman 6 months later, sending the signal that the rules of the game had changed in the final quarter of the last play. The firm that had survived the Civil War did not die because the crisis of 2008 was too large for it. Lehman had survived larger dislocations. It did not die because Richard Fuld was the only reckless banker on Wall Street. Every institution in that room on the night of September 12th had taken on leverage and accumulated mortgage exposure. Lehman died because three separate decisions, each rational in isolation, compounded into an outcome none of its makers intended or wanted. Fuld bet the government would step in, because the government had stepped in before. Paulson bet a controlled failure could be absorbed, because he believed the market had been given enough time to prepare. And the British regulator followed its own rules, declining to expose British shareholders to an American institution's liabilities on 72 hours' notice. None of these was irrational. Together, they destroyed, in a single weekend, the firm that had outlasted every other catastrophe in American history for a century and a half. A company built on identifying risk and pricing it had accumulated the one kind of risk it refused to name. The risk that the rescue it expected would not come. It priced that risk at zero. The price was wrong.